Good morning and afternoon to everyone. Thank you for joining me here. It's 11 o'clock on the rain-covered United States Virgin Islands. I hope somebody else is having a little better weather than we have here. I appreciate everyone checking in. How are people from Singapore? Boyd, how you doing? Nice to hear from you. This is what's really been so amazing to have so many people from throughout the world that I've been able to actually meet and be with. It's really been a great thing to get to know all of you. I assume you can see my screen as well as hear my voice. And Albania, yeah. Saudi Arabia, yeah, that's a question. We may talk about that. I still think it is, yeah. So you can see my screen, that's good. And you can see the bull and the bear, so we're ready to do this. And there's lots of questions that will come in. I'm not going to be able to answer all of them because what I really want to go over these entry techniques and ideas on that, but I will do my best. And if you write questions, make them short. There's one here, there's a couple paragraphs, so try to truncate them as much as you can. The basic question is, when would you get into gold or gold miners, and what factors would decide your entry? Well, we're going to be looking at that today, Greg, so just bear with me and we'll get to that. And I'm a commodity trader. So I don't look at the ETFs and the gold mining stocks and all that. I like to deal with the principal, not the agents, all these little things that are attached to the major commodity. That's just me, but that's the way I look at it. Okay, with that, let's begin. This is the art of trading, right? There's like these guys that skydive with those squirrel suits and jump out of planes. And it looks like it'd be a lot of fun to do, but it can also be pretty dangerous as well. More questions. Reporting will let you know when it's available. Best course you have for futures trading. Norm, that's a great question, but it really depends on how much of my stuff you know. What I tell everybody, start with our basic course, cracking the code. It's only a couple $100, and that's really the place to start. See if it's even for you. It might not be for you. Start with that, and then if you want to go get an advanced degree, we've got that available. But start slow, whether it's my stuff or anybody. I don't have time to talk about cattle today. That's a forecast technique. We do cover that on Larry TV. We've been bullish on that. I think we're in a bull market, looking for a buy point a little later on here. Okay, well, there's a question about China. I'll answer a couple of these so we can get started. But the question is, what do you think of the stock market in the United States and China? I think China is going to pull back here for a while. I think we're still in a bull market in America. Again, the best place to get my immediate market commentaries on Larry TV at $25 a month. I mean, that's got to be the cheapest thing out there, and we do that almost every week. So we're in a bull market. I think there'll be a significant top later on, but not yet. You got to have that disclaimer. There's no representation being made that any account will or is likely to achieve profits, losses, etc. This business of trading commodities is not easy. It's filled full of risk. If somebody tells you otherwise, they're dead flat wrong. Interesting, Louise and I were at a cocktail party last night, and one of the guys there was a sculptor, a world-renowned sculptor. I happen to know a friend of mine who's a sculptor. And we were talking about how he makes money sculpting. I said, that looks easy, and we both started to laugh. I said, there's no easy way to make money. People think it's easy to make money trading. It isn't. Guys and gals, this is hard work, and if you think this is going to be just something that mints money, you go find it some other place. Because in my years of doing this, I've not found it here. What I have found is that there's risk, and you have to be careful about that risk factor in the marketplace. So, disclaimer. More disclaimers. Hypothetical performance. You guys and gals have seen this all before, but we always have to put it here. That's a requirement of the government. Okay, let's look at types of entries. I want to look at the types of entries that we have in the marketplace. And I think I can break them down into mathematical, chart formations, market structure, seasonal, like my trading day of the month, trend change, things that indicate trend change, and momentum patterns or patterns and momentum. So many questions. This is about entries. Money management, we've written a lot about that, Joseph, so go read about my money management. And really, what people don't understand about money management, it's emotional management. Some people can withstand a 20 or 30% loss in one trade, doesn't bother them, some can't. So there's a lot of formulas for money management, but ultimately you're managing your emotions, so you have to figure out where you are and how much risk exposure you can handle. That's the bottom line, really big secret to money management. So try to keep that in mind. Okay, so these are potential entries. There might be other entry techniques, but I think I've broken them down into these 6. And what I want to do today is review these and then give you some insights into these entries. So let's start. Mathematical, usually should be the most typical one, would be one moving average crossing another moving average. That's probably the oldest thing in the books. Here's an example of that. We're looking at cocoa, and when a short-term moving average, that's the red line, crosses below the blue one, that's a potential sell signal. And then the blue crosses, red crosses back above the blue, a buy, crosses back again, it's a sell. Same thing down here. So it can get whipped, but it caught a pretty good move. Then it went long again, and Louise wants us to hold up for just a moment here. So I guess I will answer some questions that have come in here, so bear with me a moment. Flavia, you're in Malta today. Wow, how's that? I've never been to Malta, one of the few places in the world we haven't been to. Are you going to do an exit seminar? We hadn't even thought about that. Gary, that's not a bad idea. Are you going to have a separate Q&A answer at the closing of the seminar? Along the way, you can ask questions as we come along. I'll try to handle them. And if at the end, if I haven't answered your question, just answer the question again. Yeah, Enrico, I'm still running. Well, my age is more like shuffling. I don't know if you can call it running anymore. But here's a question I can answer. What is your risk-reward ratio that you use? It really depends. As a very short-term trader, it's going to be a different risk-reward ratio than a long-term trader. Ideally, you've got to have at least 1-to-1 or close to 1-to-1 as a short-term trader. As a longer-term trader, because you'll probably have less accuracy in your trading system, you need to have probably 2-to-1 to start, 1.5-to-1, and try to get up to 3-to-1. What I have found is that whenever you increase your risk-reward ratio, so your average profit trade is 3 or 4 times your average losing trade, boy, that's a great thing to gain. But near as I can tell, you always give up percentages. Your accuracy drops. I have yet to see any way to get high accuracy and large risk-reward ratios. You get one or you get the other. And I don't know how to get around that. It's not for lack of trying. It seems to be like the law of gravity. You get one of them or you get the other one of them. It's a great guru of trading. I don't know about that. I feel like the very small guru of trading most of the times. Okay, so mathematical typically is one moving average. In this case, I think we're using a 5-day average versus a 20-day average. And we're going to talk about this in a moment. But the basic idea is when a short-term moving average gets above. And this is a beautiful sell signal up here, as is this one. But this buy isn't good. Here's a pretty good sell signal, and this buy signal isn't good, but neither is this sell signal. So people have gotten all wrapped up in mathematical trend changes with moving averages, and the lessons I've learned is some work like magic, some don't. But this is going to be true of all of our entries. Sometimes an entry will look like it's a gift from the gods, and other times it doesn't. Why is this? That's the big question. Well, time periods clearly matter. So if you're in a market that has a very short-term choppy cycle like the S&P 500, your time frame is totally different than somebody who's using a time frame for the British pound that's a much slower moving item. Follow-through is really important. I'm going to show you what I mean by follow-through. Notice in this case where we had a potential buy signal with red line cross blue line, we didn't go higher the next day. There was no follow-through. Same thing over here, red line cross blue line, no follow-through. Here we had follow-through, we had a losing trade. Crossed above, very little follow-through. So the idea of follow-through, here we had great follow-through on the downside, and we went lower and continued making new lows in the market. So one idea is to have follow-through in the marketplace. Whatever your mathematical strategy is. And also to accept immediate failures, and this is huge. This is really big. Here's a buy signal, and it fails right away. Well, that means it wasn't any good, and you probably want to go back to the short side of the market. Another one immediately fails. That tells us that it didn't work. So when something doesn't work, that's a real strong message. However, emotionally, when we get this buy signal here, whatever your system entry is, we believe it, and we believe it out into the future, and we don't accept reality that it has reversed. And we're going to talk more about that later on, the ability to accept immediate failures. I want to see follow through, and if it reverses, well, there's a huge message there, but we're so stuck into this trade must work that we don't take the reversal, which is the really good trade. So you need to vary the time periods. In this case of coffee, Michael, I don't know why you're muted. We cannot mute you from here. And yes, it says being recorded. In this case, coffee, the short-term cycle has been about 12 days. So I want to use moving averages that are 12 days or parts of that. I could use a 6-day and a 12-day. I could use 12-day and 24-day. So notice it's not nearly as choppy as the last chart we saw because I'm using longer term moving averages. But these moving averages are unique to A, coffee, B, coffee right now. Coffee will not always be in a 12-day cycle. If it was, we'd all be multi-billionaires. We'd know every 12 days, buy, every 12 days sell, whatever. The cycles change all over the place, so you have to continually figure out, guess, if you will, what the current cycles are, then make your moving average techniques based on those cycles. That's the real important thing about any of the mathematics. Do I ever use options on futures? I don't. Louise does. Maybe she'll do a webinar on that sometime. But I'm not the option expert here. Louise is. Follow through can be defined really simply. Notice we have a crossing red line, blue line, not that it even matters, like, oh, the trend has probably changed. And I continue to break out. So there's the first entry, and I'm buying a little bit higher, but I'm proving that, in fact, this has happened in the marketplace. Just you want to see follow through, a further extension of that move. So those are moving averages, and there was a study done by Merrill Lynch years ago. Oh my gosh, I read this in 1969 maybe. And Merrill Lynch had this study of what the best moving averages were for cattle and corn and pork bellies, soybeans, all the things we used to trade, plywood, lumber, eggs, potatoes. And I think an 18-day moving average was the very best to trade cattle with. Then, thanks to the computers were just becoming of age then, we duplicated that study from when they published it on out for the next 3 or 4 years. And in each case, out of almost 30 commodities, none of what had been the optimal moving averages were the optimal moving averages in the future. So at that point, I really gave up on moving averages amounting to much of anything on their own. On their own, you cannot make a moving average system that is going to be really very successful because they change all the time. And that was, back then we all thought that was the answer. So I moved from moving averages, they're an indication of trend, they show where the market has been, to maybe chart formations. And is there something on these charts we look at that can help us in this? And Alan asked, do you have cycles for all markets in the industry? I work on these all the time. We do them on Larry TV. We talk about it there. Here's another great question. There's a lot of moving averages. There's front end weighted, back end weighted, supersonic moving averages, Hall moving averages, extended, all. You know what? I've researched them. And the basic, simple moving average, not an exponential, test out better than all of the others. So in my work, I just use a simple moving average. I think that's the best. Year in, year out, I've tested this for so many tests in different ways, and just a simple moving average is what I use. Okay, so there are lots of chart formations like reversal days. You're aware of those key reversal days, heads and shoulders, wings, wedges, wings, and all sorts of things. Each has different rules. So if you read the chart books, you're going to read how to handle reversal days, heads and shoulders, and all that. And in that case, they're really rules you're going to have to learn. I can't go over them all here. I'm just pointing out, like, here are some patterns that some authors think are significant patterns, and I think that there are patterns. Some of you know about my oops pattern or my fake out pattern, things like that I do use. But they're very short-term entry techniques. Now, later I'm going to try to roll all this into actual trading, but I just want to look at potential ways we can get in the market, because this is the key point here. Markets don't always top and bottom the same way. It's almost like a deck of cards. It's random where the ace of spades is in a deck once it's been shuffled. And it's random as to how soybeans will bottom this time versus how they'll bottom in 30 days from now. So there's a lot of different ways a market can trend reverse. That's why I like to have a lot of arrows in my quiver. I want to know potential entry techniques. Well, one of my very favorite is short-term swing points in the market. I want to buy a higher short-term low. I want to sell lower short-term highs. This is basic Larry Williams 101. That has been the best year in, year out that I've used for the market. So let's take a look at that. So I've marked off all the little short-term swings in the market. This is coffee. And I'm forming a lower short-term high on this day than here, so I know I can be a seller at the prior day's low. And note I continue making lower short-term lows until I make a higher, lower short-term highs, until I make a higher short-term low over here. At this point I can cover the short position. I could go long if I'm bullish. But then I take this out, so I'm back to the short side. Again, I make a higher short-term low. That's a buy point in the market. And I continue making higher short-term lows. So I'm very interested in seeing market structure or the formation of a higher short-term low for a couple of reasons. And these swing points are not set at anything, Akhtar. I just drew them on the chart, just visually making my best guess. The problem with it, because there's nothing perfect, you can get into a real choppy trading range here. And then finally it starts to break to the downside. It took out the last point. Additionally, think a little bit. What's the trend of this market? Well, clearly it's been to the downside, hasn't it? So I'm not really interested in taking buy signals here because I'm going against a big downtrend in the marketplace. So I would prefer to take the sell signals because the overall trend is to the downside. But structure lags. Well, structure doesn't really lag. It identifies the problem. If you sell here because we're in a downtrend, well, you have your head handed to you. You run up. Market structure tells us, aha, the price is reversed. And that's where I want to come in. I want to come in as a buyer here, not here. I'm willing to let that dagger stick in the floor and the market bottom for a couple of reasons. First of all, even if I was fortunate enough to buy the absolute low day, I'm back in pain again over here when we come down. I had a trade this week. I was looking to buy crude oil. I thought, it's a buy point here. Now, Larry, wait. The market structure will come up, come down. Wait for structure. Had I bought long, it would still probably be a good trade, but I then go through days of anguish waiting for this thing to work. So I want to get in as optimal of a point as I can. Candlesticks, I don't use candlesticks. I don't know anything about them. I've tested them. I didn't find them to be helpful. I know there's been a big marketing push of how great they are, but we tested them a lot, and we weren't able to come up with a way of making valid entries with high statistical probabilities to them. Thomas said, yeah, we're going to get into looking at other things because that's really why entries work or don't work. So bear with me a moment on that. I also like to use seasonal time periods when I want to get in. They can be very, very helpful in the automatic trading strategy. We have a trade station. We've been running that for years now. It's been consistently successful. A lot of the trades are just based on the best trading day of the year or of the month or whatever. So these can be filtered. Obviously, buy signal and an uptrend is going to be helpful. Is price congruent with the seasonal? This is a huge input. And on these short-term seasonals, what I found is you don't want to wait for much confirmation. So if I have a short-term seasonal to buy over here, I'm just going to probably buy that day on the opening and have my stop. Wouldn't have worked in this in this pattern. But usually the problem with the seasonal one, you have a seasonal buy here, and by the time it breaks out, you're buying here and the trade's almost over. So what I found in testing very short-term seasonal influences, you really don't want to wait for much confirmation. You want to get aboard, but congruency is really important, and are we in an uptrend or a downtrend in the market? Hey, the sound is better now. Glad to hear that. Yeah, and you can use the ultimate oscillator. We're going to look at some oscillators in a moment as well. It's an interesting question. I feel like candlesticks with colors red and green scare you out of a trade. Yeah, that's a great point. The more stuff you have on your charts, the more messed up you're going to be. It's like multitasking. If you ever tried to juggle, I learned to juggle 3 balls, but 4 balls was an impossibility for me. But try juggling and driving a car. Oh, try driving a car, drinking and texting at the same time. Cannot do it. Dangerous. Illegal. It's so dangerous. So the less visible distractions in front of you, I think the better you'll be as a trader. And what I usually see when I look at people's charts, they have a plethora of indicators on them, and they're all redundant. There are Bollinger Bands, there's Keltner Bands, there's Larry Williams percent R, there's Bollinger B, they're all doing the same thing. On my charts, each indicator has a specific and separate purpose. One for momentum, one for accumulation, one for trend. So I don't have redundancy of indicators. Have any of your entry ideas from past teachings become obsolete? No, not really. The entry techniques are just part of, and a very small part of the equation. Trend change, well, this is the biggest entry technique of them all. Trend lines, channels. Dick Donchian, a friend of mine, passed away unfortunately years ago. Was the first really channel guy. Then Richard Dennis did the turtles. That's a way of noticing trend change. Closes, instead of buying the highest close the last 8 days, not buying the highest high the last 8 days. In channels, that actually has been probably a little better than the highest high. And to make an adaptive channel. Changes in momentum. I'm going to show you some stuff here you like. And the volatility measures. The original idea was developed by Gresham Northcutt and written by Wells Wilder in his books. So trend can be identified, the change of trend, in a variety of ways. The simplest is probably a channel, because it's real simple. You can put it on your chart. Nothing too fancy about it. I don't know who Michael Huddleston is, so I can't comment on it. Yes, I do still use LTSI. We're going to be doing some stuff with that. I think today we'll look at that. Only price on multi-time frames is enough. I don't use multi-time frames. I'm an end-of-the-bar trader now, so I'm going to use market structure, trend change. I just use daily charts. Again, I don't want to be too confused if I start looking at intraday charts. It's just too much stuff going on. So let's look at these entry techniques. Well, there's trend lines. This is probably the simplest, and you know what? It's one of the very best. So when would I enter this trend line? Well, as soon as I get down to the trend line, I can sell it. Those who've taken my course material know we have a couple rules to confirm this trend line, but basically trend lines, we had a trend line coming off these highs, market never got up there, have to draw another trend line. We're simply taking the lowest, the 2 most recent short-term highs. There's a short-term high here, short-term high there, and drawing the line between the 2 of them. We have another short-term high, but this is ascending, so we need a descending one. We come down, there's a trend change in the market. This is so simple, and most people walk right over it. The good question came in about, how about high-frequency trading? I don't know if you noticed, but I think it was the Wall Street Journal this week or last week had a story about how the high-frequency trading guys are falling apart. They were doing like $7 billion a year, and now they're down to $1 billion a year. And of the high-frequency trading funds at firms, only a couple of them have consistently made money. I think Renaissance and maybe one other, but it's nothing that is even in my world. I don't think about it. It's a game I can't play, and I don't think it affects the game that I play. So I'm just going to be worried about my trades in the marketplace. Well, that's a good point. The problem, we've got to have an entry, you have to have an exit. You have to have both of them. Maybe we'll do a seminar on exit techniques. But basically, I can tell you what my exit techniques are. You might want to write these down. I'm going to be exited with a dollar stop loss. I'm going to lose money on the trade. I'm going to be exiting at a trailing stop, or I'm going to be exiting at a target. Those are the three exit techniques that I use. And there's probably ramifications of that, but that's it. Dollar stop, I lost so much money, I'm out. Trailing stop loss, or a target in the trade. What do you think about point and figure charting? Well, I think point and figure charting, after you have a losing trade, you point at the chart and try to figure out what went wrong. I don't have any use for it. Abe Cohen, who wrote the granddaddy book of point and figure charting, admitted himself that in his 3-box breakout, 50% of the time the trades don't work. So when I read that, plus it's just a representation of price. But everybody, just because I negate something, doesn't mean that I should negate or invalidate that for you. You may figure out how to work these things. Ultimately, you have to figure out whatever it is that works for you. Here's a good example. I can speak a little Spanish. Really hard to learn Arabic or Chinese. I just can't pick up on those languages. So you've got to find the techniques that work for you. And we're all going to be a little different. Maybe that's why markets top and bottom at different times. But if, and this is the big if, this is the point we're getting to, these trend lines, these entry techniques don't work on their own. They work because of the conditions in the marketplace. And that's what everybody has forgotten. How do I get in here, get in there? They're looking for some magic entry technique, but the entry techniques are only as good as your ability to know you're fundamentally set up, cyclically set up by accumulation and distribution for a market to rally. Entry techniques are the tail on the dog, and that's what people haven't understood about entry techniques. Here's a great example of this using a 12-day channel. This again is coffee. So we've got a buy signal here, sell over here. Wow, lost money in that trade. Lost money in this trade. Then we pick up a pretty good trade in the market. But wouldn't it have been wiser to buy here and get out at a target, sell here and have a trailing stop? Of course it would have been. So the channel technique works really well to capture big moves in the market. That's what the turtle technique is all based on. But my experience has been you need to overlay that with, once you're in a channel technique entry, then have a tighter trailing stop and look for targets in the marketplace to really make channel techniques work. But the bigger thing is, clearly this market was not set up to have a big rally down here. So I'm much more concerned about the underlying conditions of the market than the entry techniques. What do you think about monitoring smart money? Well, I don't know about order flow, but we combine price, open interest, and volume all into one indicator that measures accumulation. So I definitely like to see that we've seen some professional accumulation in the marketplace. So I like the idea, I always have, going back to my writings in the 1960s, looking at accumulation. What is the best way to tell the market is overstretched? William, this is a really interesting question, and it really relates to this. There's no be-all, end-all answer. If coffee is in a 12-day cycle, then a 12 or 20-day overbought or oversold indicator will work the best. But in a market that's in a 30-day cycle, that's not going to work so good. So you have to adapt your overbought, oversold indicator, and they're all the same. My ultimate oscillator, stochastic, they're all going to give the same thing. It's the numbers you put into them that make them work better, and those numbers have to come from studying the marketplace. And that will help you filter out choppy ranges. How much capital should you start with? Depends, I started with $6,000, a little less than that. So now, that was years ago. It was a lot of money back then, but now probably 10,000 realistically. Okay, do you determine the length of the cycle? I determine the length of the cycle by just counting. So I'm going to count how many days from here to here. 1, 2, 3, 4, 5, 7, 8, 9, 10, 11. Oh, it's 12 days. How about from here to here? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 13 days. oh, we're probably in some type of 12 or 24 day time period frame. So I just look at the charts and count them. There's a lot of fancy software out there that can help you determine the cycles. John Ehlers has some. Timing Solutions is really good for it. So you could use those, or if you don't want to buy software, just count the number of days on the charts. The soybean meal in a good soy time, not quite yet. We just did our Larry TV, so go to Larry TV. That's my market forecast there. We're close, but not here yet. How does your trendline entry compare with Tom's? My good buddy Tom DeMark really had some breakthroughs in trendline techniques. I've added some couple of rules to Tom's trendline rules, but I definitely think the idea of qualifying that trendline entry is really important. Why do you prefer commodities to spot Forex? I'll tell you why I like commodities better. Spot Forex, commission's a lot higher, so I'm cheap. You know, I can trade round turn in and out for $4, something like that, and Forex you're going to be paying pips 2 in, 2 out, whatever. Your cost of business is higher, and it's not a regulated market. So those are my answers. Are you saying RSI period should be more than the cycle period? What I'm saying is that you have to make the whatever oscillator you're using or trend mechanism, you have to make that fit the market you're trading. Here, let me show you. You're going to see some important things here. One size does not fit all. This is the equity curve of buying coffee, and I'm going to use the exact same trend changes, moving average. I think there's a channel breakout actually, buying the ISI the last 8 days, selling the lowest low the last 8 days. Wow, looks like we figured it out. This goes back, this is 800 trades now. That's a really good system. Doesn't go straight up, but you know, it continues making new highs. Whoa, we found the Holy Grail. Oh, now I put this though on sugar and did really well for a while, and then it didn't go any place at all for 400 trades. It was down, and then it came back, and now it's been choppy for quite a while. So it looked pretty good here. It didn't look so bad there. Maybe we're onto something. Oh, here it is on the British pound. And the British pound is one of the most trendable commodities. Look at it, didn't work at all. So one size doesn't fit all. That's so important to realize that this looks like it works. Well, we found the holy grail of a moving average or channel breakout system, or did we? Or did we? This is the same thing in the E-mini. Clearly, the E-mini has a different time frame of reference than the British pound, sugar, or coffee. So everybody wants to have a one be-all, end-all, one little thing you put in your computer and you make money the rest of your life. It ain't there, folks. Sorry to break the bad news to you, or at least I never found it in 55 years of doing this, 53 years, whatever it's been. And, you know, I've looked a lot of places, spent a lot of money at it, and have a lot of friends that have spent a lot of money on it too. One size doesn't fit all. You have to get the time frames your market is in, and the S&P here is a great one. Very short-term in and out trading strategies work very well there that will not work in the British pound because it has big explosive moves and then pulls back. It's a choppy, it trends, but it goes up, down, down, up, down, down, up, down, down, up, down, down as it makes its trend. The other markets go up, down as they make their trend. So it really matters what market you're trying to trade. Okay, some questions have come in. What is your taking on astro? I don't know anything about astrology. I think there's a lunar effect of stock prices. That's based on work done at the University of Michigan School of Business and also the Federal Reserve System. You can Google those articles. They're pretty interesting. But the rest of it, I don't know anything about it. I looked at astrology, and it's one of those things I don't have the mind for it. You got to look at all those little moons and Mars and Venus and signs, and it's like way too complex for me. So I might work really well. I don't know. It's not my mindset. And as you know, I'm really big on it. It's got to be something I can adapt to. So that's my comment. Okay, let's see. Have you ever looked at drum and trading? Yeah. You guys stop looking for all these things out there. There's no one be-all, end-all holy grail. If there's a holy grail, it's trend lines. You know, stop looking. That's really in front of you. I had an email today from a kid in Russia. It just infuriated me. He wanted me to help him in the marketplace and tell about WD GAN. And wanted to know what the secret was. I don't use GAN. This is how I did my research. I looked at the markets. It's there in front of you. Look at the markets. Stop reading the books. Throw up your TV. Blow up your TV and radio. Just look at charts, and you're going to start to see this stuff after a while. Hopefully, I can give you some insights and kind of move you along the path sooner by breaking down, hey, there's only 6 type of entry techniques we can have. Well, so now we know that. So then you can focus on the ones you like or you understand this stuff better. Okay, more questioning. How much time do you have to look back to calculate those cycles? Yeah, I like to look back a couple years to be consistent. It's interesting. If I had some general numbers, I'd throw out in the financial stuff, 90 days, 180 days seem to be pretty dominant. They're usually there because that's the terms of business, isn't it? You have 90-day treasury notes, 180 days. So you want to look at, in a business, what are the numbers that are important in that business. In the stock market, every 3 months we have earnings reports come out. So guess what? Same thing there. Those are fundamental numbers, not based on astrology or mythology or some weird number. They're based on exactly how business is done. So look at those numbers. We did a report on Larry TV today talking about the corn market. Well, guess what? Corn market relates to the Japanese yen and to an extent the Nikkei. Why? Well, 26%, almost 30% of our corn exports, corn grown in America, are exported to Japan. So sure, there's going to be a relationship there. So look at things like that. Those are real things that really matter about these markets. More questions on money management. Yeah, money management allows you to extrapolate your wealth. And read Ralph Vince's books on it. Ralph was the smartest guy I've ever met in my life, and I met a lot of people. There's nobody smarter than Ralph Vince. Read his books on money management. We'd be holding a live class this year. I don't know. We might do a class. We're still working on that to see what we're going to do. I don't have the energy I used to have. I don't have the drive I used to have. So there's been a lot of requests for it, and we think, well, maybe we'll do it one more time, but we haven't figured that out yet, haven't committed to it. Okay, now here's another entry technique I want to teach you about that you probably or may not be aware of. Do you usually use stops? Yes, I always have stops in the marketplace. They're resting there. I don't think that they're going for my stops. I think the stops are critical to have. Some of my friends, Vic Niederhofer doesn't trade with stops. I do. I've had too many instances in my trading career as a young man where I had a mental stop in the market and it went there and I didn't get out and I thought it would come back and it didn't come back and went lower. I decided to get out another price. It didn't come back. I rode the puppy all the way down. So if I'm wrong, I'm wrong and I get out. So that's my trading style. That's what works for me. Will it work for you? Maybe you're too paranoid about them going after you. If you're as paranoid as Alex Jones, I think he's a talk show radio guy, right? Well, it ain't going to work for you. It works for me. I found that they don't go for my stops. If I'm stopped out, I'm actually glad because it means I was wrong. But my stops are not real close to the market, so the market's got to have a significant move to say, yeah, Larry, you're wrong. The closer your stop to your entry technique, the more often you will be stopped out. So if you think they're out to get you, it's because your stop is too close to the market. What percent of your capital do you risk on a trade? Well, at my old age here, 2 to 4% risk is plenty. Do you use momentum divergence? No, I really don't. So let's talk about momentum here, okay? This is just simple stochastic, slow stochastics in everybody's computer. And all we're going to do is take the slow stochastic. When it gets above 80 and crosses over, there's our sell in the marketplace. There's another sell in the marketplace. When it gets below 20 and turns up, there's our buy in the marketplace. Sell, buy, sell. Oh, here's the problem. The red line didn't ever get down into the blue area. You got a great sell signal over here, though. And again, it got into the buy area. The red line did, and turns up. We got a nice trade. Another really nice trade. But the problem is this. you may get a sell, but you never get oversold enough to get an opposite signal. So this can be a very good entry technique when you're conditionally ready for a market, but you're in no man's land, because this market could spin on a dime and reverse when the red line's not into the buy area yet. So it can be a really good entry technique. Any momentum technique can be very powerful. The one I teach in the Art of Trading class is a little pattern. We trade a pattern momentum. It's absolutely phenomenal. I've been using it since 1967. I first saw it in a stock called Deltona. It's just phenomenal entry technique. And then you have to follow up and know when to get in and get out of the trade. But a lot of people are looking for divergence. Like, oh, the market went higher here, and we have a lower peak here than here. I found that you may have a lot of divergence and the market keeps going higher and higher and higher. So I don't use divergence at all. The last is not a nice trade. I think you're talking about here. You sell here and you get out over here. You had some profit in the trade. But notice all of these trend entries, we sell here and get out here, by the nature, and listen up here, by the nature of a trend entry, you're always going to miss the high and miss the low. I don't mind missing the high if I'm going to be a seller, or missing the low if I'm going to be a buyer. But my exit technique, I don't think, should be the same trend mechanism, because clearly I'm going to be a long way from the low, so I'm going to have a tighter trailing stop or a target, as I mentioned earlier. So I may have a trend entry, but I won't use the exact opposite thing for my exit in the marketplace. Does that make sense to you? Do you see that? And this is the settings for this. There's no magic. Remember, one size doesn't fit all, guys and gals. This is just whatever's set in the trade station, 21, 2, 11 or something. It doesn't matter. There's no magic to these numbers, unless, of course, you know the cycle the market is in. Because all markets have different time frames, and damn it, they keep changing. That's the, you know, you got to stay alert. Like I was saying at the party last night, we both started laughing. Yeah, there's no easy way to make money. This is work. You got to keep alert, because things will change. The time cycles change, so you got to be prepared to do that. But all markets have different time frames. You saw the channel breakout that worked so well in coffee didn't work so well in the British pound, and it was a disaster in the S&P E-mini. So guess what? You have to be congruent and up to date with what's happening. But we can still use changes in momentum. Here's an example. There's the sell, there's the buy, there's the sell. But you know, in this case, this is crude oil. We're just getting into the buy area now. But you had the potential for moves against you. So again, if you're going to use a trend change indicator, great, use it to say, I got to get in, but then have something else to get out with. Don't use the exact opposite of your entry for your exit, because you'll leave a lot of money on the table. So that's one way of using momentum. I also like to look at momentum patterns. They're probably the most powerful of the arrows in my quiver. But momentum and the change of momentum can be very helpful. Most people don't focus on momentum. How successful is hedging in different contracts the same month? It hasn't been very successful for me, because whenever I try to hedge, I get confused. I just need to keep it simple. I am not the smart guy in this webinar. Just smart enough to figure out that if it's not something I immediately understand, I should not do it. Now, a lot of people, a lot of you are mathematicians, and your minds think so much quicker and are much more brilliant than mine will ever be. That can work for you. But for me, juggling 3 balls took a long time to learn. I juggled 1 ball really well. I can do that all the time, even now. But the more complex it is for Larry Williams, the more difficult it is. It doesn't mean it's that way for you. I'm just giving you my experience here. Red lines and blue lines are what again? The red line is the slow stochastics. The blue line is the fast stochastics. It's the general setting that's available in anybody's machines. Do you use Fibonacci replacements? No, I don't use any of that. I gave up on Fibonacci. I don't think they work. I know they don't work. Why do I know that? Because I tested it. We did a study, and it was replicated by some other people as well, where we literally looked at this swing move from here to here and what was this percentage of pullback. This move from here to here, what was a pullback. This move from here to here, what was a pullback. And we found that there's no common point markets pull back to before they take off again. And certainly the Fibonacci numbers were not high, nor was 50% retracement number. It was all over the board. It was random. So, a lot of people have made a lot of money selling Fibonacci ideas, but when we tested it, because that's what I do, I test stuff, we found that it did not work. It was also done on intraday charts, and again, not a study I did, but someone else did. It's in my material someplace. Same thing happened. It was random, where the high or the low of a day was going to occur based on percentage retracements, retractions, and all that stuff. Do you add to winning positions? You probably know that I don't, because it's complex, right? I want to be long or short or flat. So that's just me, though. What is the best indicator of accumulation? Oh gosh, I don't use fast stochastics, by the way, to answer that question. I'm just showing it on a chart. It's in everybody's computers. You want to know how to use it? There's one way to use it. That's all. For accumulation in commodities, I like my POVI because we combine price, open interest, which is really important, and volume all in one. For stocks, OBV on balance line, pretty good. It was originally done by Woods and Vignolia, a couple in San Francisco, popularized by my friend Joe Granville. But I think that the measure I did, where we look at the change from the opening to the close of the multiplier of volume, is better than OBV. It's not as biased. So those are the general ideas on accumulation. Okay. Tell us your techniques when you won the trading championship. It was really easy. I just used a very aggressive money management. I followed every tick in the market. I did some day trading. I did some overnight trading. I was a miserable son of a bitch to live with because all I cared about was the market. I was absolutely, totally focused on the market. And I used breakouts, same stuff we're talking about here. Short-term higher lows, short-term lower highs, same old stuff we're talking about here. I was just very, very aggressive in the marketplace. When my daughter won it, that was the basic same thing she was doing, finding a setup condition. We're going to talk about those in a moment, and then using entry techniques. So here's the same stochastics, right, for crude oil. Now we put it on the stock market, and guess what? It doesn't work at all. Because time frames vary. Here we got a nice sell signal over here, but we didn't get a buy signal till over here. Then we have a sell here, and we still never had a buy because we didn't get oversold enough based on this indicator. Again, my point is, one size doesn't fit all. That clearly this market, look how choppy this is. This is the way the S&Ps trade, up, down, up, down, up, down. Whereas crude oil isn't nearly as choppy. It's a more methodical market than the S&Ps that are filled full of chop. Why is that? Why do you think that is? Because this is the second most actively traded vehicle in the world, and there's people are in and out, short-term traders are back and forth, so it's a choppy, choppy market. Volatility breakout entries still work? Yeah, sure. Do you need a shorter time frame for the S&Ps? Yeah, for my automatic trading strategy, I have the length of trade is maybe 2 days. So that's much different than where we're doing longer term. In your research, have you compared breakout entries versus reversal point entries? Yeah, I'll answer that in a moment. Do I shift from stocks to commodities? Yeah, I actually do both. Alan, use timing similarities. I don't know what that is, Mohammed. So how do I use percent R? Because that's an entry technique. I cover that a lot on Larry TV. Also, if you go to our website, ireallytrade.com, we've got an article about percent R there. So go there and read that article. That'll probably explain it to everybody. You can see how we use it. Any news environments make you ignore chart? I don't read news. I don't have a clue what's going on in the world until way after the fact. I think the markets predict the news. I think cycles predict the news. So I see the world the other way around. Not that I'm right, but I think I'm convinced there's a significant sell-off happening later this year. The news will come out then. As so you know, we got really bullish in November, last November, the first couple trading days in November, because that's what the cycles were saying. Then the news came out. So I think that news is predictable by cycles, not the other way around. Is there always a momentum count that will work on a given market? Well, the momentum idea works, but you have to adapt it for that market, and still you're going to miss out because there's more stuff we got to show you here today, okay? But let's look at another entry technique, volatility measures. This is my will stop. This is one that I'm really proud of. Developed this in 1980 something, and markets that don't trade anymore. Pretty good little measure of trend. It gets whipped, everything will get whipped, but it can hold on to trends for quite a while in the marketplace. There's another. This is in the E-minis. Nice buy signal. Oh, still long. Oh, back and forth. Long, back and forth. Still long. Oh, rides a move a long ways. This is based essentially on market structure. Most of all of you have taken our classes, so you know what the rules for it are. We're generally looking at the lowest low of the last 3 days if we're long, with some little rules we've added into that based on understanding how markets trade. And that's all there is to it. So imagine if you have a long-term trend change down here, then you can use this to take your profit and get back in. So there's a lot of ways you can use that, but it is a measure of volatility in the marketplace, so it adapts to what the market is doing, which is the big point I've been trying to make all along here today. It isn't the same for every market. Some markets are more volatile, so you want the market to dictate to you. You don't want to dictate to the market. That's what you guys and gals have been doing. Oh, I like an 18-day moving average or whatever it is, so you try to force that on the market. I'm saying, no, don't do that. Let the market force on you what it's actually doing. So right now we see in the E-minis, we got a little sell signal a couple days ago. So we're in a downtrend until we reverse back to the upside. Or you could use will trend. That's a longer term measure. Notice this gets pretty choppy, doesn't it? That's for short term traders. So a longer term trader would use our will trend, and you're going to catch longer moves. Still long from way back here just before the Trump election to a couple days ago. So that's a longer term will trend. It would be comparable to the wilder volatility stop. I think we made some big improvements in it, but the general idea is what you're interested in. Is the trend up or down? We really inherently know that it's up, but we are unsure, so we need to align on our chart. So yeah, price is above this, so we're in an uptrend, and you got to keep referring to that. So any of these are going to give you pretty much the same idea. Some might be a little bit better than others, but generally speaking, I like some. Says the trend is up, and I can't sell short here. The trend is up. So that's the purpose of a volatility measure, I think. More questions. Are the videos of your trading life experience you recommend at the Traders Expo in Las Vegas 2014 available on your website? I don't know what's available. You can probably go to YouTube and pick up a bunch of stuff. How do you use E-mini for intraday trade? I don't intraday trade anymore. It's not big money, so I don't do that. I think big money is made in using daily time frames and trying to catch 3 or 4 days, not 2 or 3 ticks. Is Larry TV applicable for beginner? Yeah, I think anybody can use Larry TV. It's not complex. Do you have the registration of this webinar? The one we're doing right now? I don't know, Angelo. I guess. I don't know. Okay, so another volatility measure. Now we're looking at the E-mini on a intraday time frame. Oh, I hate to show this, but I know a lot of you are intraday time frame traders. I don't use a 15-minute bar chart, whatever. I'm looking at a number of ticks that make up a bar or shares. This is a 10,000 share bar. So these bars are not determined by time. That's why they're equal. They don't look erratic like intraday bar charts do. And again, you can put a time frame reference on that. Oh, the trend is up. I can buy pullbacks. Oh, the trend is down. Sell. Up. Stopped out. Oh, we're back to the upside. So the same idea of a volatility measure works on intraday or daily or weekly. You just have to adapt it to the time frame that you're going to be a trader of. That's really all you have to do. Can you summarize which course you use entry techniques? I'll get to the course in a moment. Just bear with me on that. So it's all about what is your trading window. Here's 10,000 shares again with will stop. this is my really close, right? So it really holds close to the market. So is this your time frame or is this your time frame? I don't know. You may not. You probably don't know. You may not even thought about this, but you should. I know for me, I'm not interested in intraday trading. I don't think there's big money there, and it's not comfortable money. It's hard work money, extra hard work money. So I like daily charts. But you have to figure out what works for your lifestyle, your job, your wife, your family, your personality, and then you can adapt these things. So here's the lessons that I've learned, okay? There is no perfect entry because they are not about a market condition. Entries are simply a reflection of a market bouncing up or bouncing down, one line crossing another line. They are technical, aren't they? All about technical and not about a condition in the marketplace. That's why there's no perfect entry, and that's why oftentimes they don't work, because you're not thinking of yourself as a conditional trader. Everybody wants to use entry techniques, but it's the last thing. Okay, a couple questions have come in. Have you done any work on intermarket relationships? Oh yeah, a lot, Steve. You'll see a couple of those today, and I think you watch Larry TV. We do a lot on Larry TV. I also use volume chart for E-mini. Why you pick volume chart? You can pick whatever you want to, whatever you're comfortable with. How do you feel about rather than using volatility to trade VX longs? The VIX index always goes down, but then as soon as you think it's going to go down forever, it has these huge, massive spikes in it, and if you're short, you can get killed. Okay, so here's some takeaways. Entry techniques are not reasons for rallies or declines. They're catapults for the moves, and I really want you to get this into your mind. They're catapults for a move. They're not a reason that we're going to have a big rally because we had a higher short-term low or a trend line change. They're just telling us the market changed direction here. But they don't know the future because they're not conditional. They're just a catapult for the move. So, lessons in pain. As some of you know, earlier this year I was in the hospital for a couple of days. That was a painful experience. And this last week I had a wisdom tooth removed. Real painful experience, still in pain. I learned to stack my meds. So if you take Tylenol on top of Advil with some aspirin, a lot of the pain goes away. And health addicts have done it, and weightlifters have done it, stacking steroids and all sorts of stuff. So that's kind of an interesting idea. You really want to stack your entries on top of fundamental setups to get better entries. So to get better entries, you want to stack your entries on top of fundamental setups. Yeah, thanks, I'm doing better. Oh, man. Our hospitals here are not efficient. They had me diagnosed with blood clots in my legs and my lungs. So I went on blood thinning stuff, and then the hematoma in my leg swelled up, and I had to have that operated and take all the junk out of my leg. Fortunately, my son was a doctor. Said, Dad, get off the blood thinners, have them run this test. They ran that test, and they came back and said, oh, you don't have blood clots. Never did. Misdiagnosis. And in the midst of that, a disaster. Anyway, so stack your meds, huh? So here's how we can stack. Let me give you some examples. Yeah, that's what we're going to do right now. We're going to show you examples of this. So here is a couple of entry techniques. I'm using a simple channel breakout here. But I have the seasonal market influence here, and I have that stochastic pattern down here. And so I have a seasonal that says, oh, we usually start to go down here. That's a condition. And I have a forecast here from our forecast technique that says, oh, this market should start to go down here. So do I want to take a buy signal in here? No, not really. But I do want to take the sell signals over here, don't I? And this is sugar, which is, those who've been on my Larry TV know we got short sugar up here. Oh, we're making lower short-term highs, etc., right? So I had a condition that suggested we should move down, and totally different condition, the seasonal pattern suggested we move down. So there's an entry technique from the stochastic, rolling from the bought position crossing below 80. You could have used that to take sell signals in here, or whatever entry techniques you want. But that's how we use other things to tell us now that entry technique should be successful. Yeah, I used to run marathons. Now I'm doing shorter term stuff. You broke your foot in Charlotte, Emily, in the hospital could only find 2. Yeah, that's Ron. I'm sorry that you had hospital problems in the Virgin Islands. It's not a good place to get sick, that's for sure. Have you designed any specific indicator strategies that identifies combines fundamental conditions? Sure, that's what I do. That's what our classes are all about. Darlings, the Dow is coming up. Yeah, we're going to roll over the end of this month in a couple of days, so I'm looking at that now. When seasonals fail, like unleaded gasoline, now I reorient. I won't use just seasonals. So, and I don't trade unleaded, but failure indicates that it's not going to work. So but I want to use more than one indicator, okay? Okay, let's look at some more examples of what we're talking about here. So here's coffee. We got long coffee and Larry TV a while ago. Well, why? Well, here's the forecast. This is what coffee should do, okay? This is a forecast based on intermarket relationships. Oh, the commercials, the red line down here, the commercials started buying coffee right in this zone, didn't they? They bought more. Oh, they're buying. So I have 2 reasons to be a buyer here. Commercials are buying, and I have a forecast that says we should rally. So here's the will stop. That's a will trend. That's a longer term. Here's the trailing stop. You draw a trend line down here. You have nice trend lines coming through here. We had a trend line. I actually went long on this day based on a short-term trend line coming down from this point to this point. So a lot of entry techniques, why they worked in this case was we had other stuff to support the trade. So that's what's going to make your entry techniques work. On their own, they're just catapults. That's it. They're a trigger. They don't tell you how big of the bullet is in the gun or how far the bullet will travel. Okay, here's another example of stacking. This is gold. Oh, we've got the cycle forecast right here. It says the cycle turns up from here to here. Our forecast based on intermarket relationships says we bottom here and move on higher. And we have a couple entry techniques. There's a slow stochastics, turns up here. We have a trend line here. Oh, they work. Why do they work? The seasonal was also up, by the way. I don't show it in this chart. But we had several ideas of why these should work. Are those entry techniques also applicable to shorter time frame? Yes, they are. If you're going to trade shorter time frame, same stuff still works. Do you still use the 50-day moving average as trend indication? Yeah, I do, but I don't have it on my chart because I look at a chart, I know if we're at an up or a downtrend. I mean, I used to need a 50-day moving average. That told me a lot. I didn't use a 10-day or 10-week. I'm sorry, you're right about that. But now I know what it is. So what makes the entry techniques work, what made this trade work, wasn't the entry. The entry just says, hey, we're on the dance floor, start dancing, there's music. What made it work and work well was the underlying conditions of the marketplace. So here's gold, and here's the seasonal pattern down here. So we had the seasonal pattern, we had the cycle pattern, we had the intermarket relationship. That's why it worked. Are you sure that was coffee chart, not cocoa? A few moments ago, that was gold, and that was cocoa. Does that help you? So here's gold on a weekly chart to again see what was going on down here. Well, we had the commercial were buyers. My surrogate index for the commercials were buyers. The green line guys, the small speculators, have been getting out of the market, and the seasonal was up. So this entry technique is going to work. Does your commercial proxy index still work? Yeah, it sure does. We'll look at some examples of that in a moment. Where can we find the forecast graphic? These forecasts are based on intermarket relationships, and we'll talk a little bit more about that in a moment, I guess. So this looks like the same chart of gold. Sorry. So here's more stacking. This is looking at gold going back in time. So notice these red dots that you see here, just automatically put on the chart. because of the relationship of price and the commitment to trader report. So the commercials have been heavy sellers here. I want to take these sell signals. At other times, like in here, they were heavy sell signals. We didn't get the sell signals. But I like to have this. This is our little picture perfect pattern. So, we probably want to be focused on the short side. And here's the picture perfect pattern on the buy side. And then we got a picture perfect sell up here. So the commercials, that's the red line down here, there were buyers here, and here we get buy signals. There are sellers down here, but we didn't get any sell signals because we need to filter the commercials. Notice the commercials, we're doing a lot of selling in here. We didn't get any sell signal in the commercials. Unfortunately, we got a buy signal here. Not so good, but those were good. Those were good. So I use the commercials, as those who've taken our advanced class know, but I'm even going to filter those commercial patterns as well. Here's stacking stocks. Somebody just asked a question about this. What indicators are offered with TradeStation package for swing trading course student? What indicators are offered in TradeStation for swing trading course students? Louise will answer on that to you. Okay, so here's one of my favorite all-time stocks, Philip Morris. Here's my surrogate index. If there were commercials in the stock market, they were buyers here and here. They're buyers here, they were sellers here, and buyers here. Here's also the seasonal pattern. So I go, oh, commercials are buying, seasonal pattern is up. I want to start buying Philip Morris. Here, the seasonal pattern isn't so bullish, so I'm not in a hurry to rush in and buy. Here, the seasonal pattern says we should rally. The commercials have been buyers. Guess what? Same thing here. I want to be a buyer. So I'll use this surrogate index as a condition in the stock market. Again, I don't think the entry techniques in stocks are much to brag about. It's the underlying condition to why these markets should move. Here's one of my other favorite stocks for income, Annaly Mortgage. Annaly Mortgage is, pays about 11% dividend. It's been a great stock over the years to own. It's way outperformed the Dow. So when this surrogate index is buyers, I want to be a buyer. Here's where we are right now. We've made new highs this week. I am long this market. And it's guess what? The commercials theoretically have been selling the market. I'm getting close into a time period where this market usually comes down. So, I'm going to take my dividend from the last dividend check in Annaly Mortgage, 30 cents a share. But I'm going to really play it a lot closer to the vest now. Because we're overextended in the market, and theoretically the commercials have been selling. What was your total net performance in 2016? Jonathan, our actual stock performance on $1 million portfolio, it's on the website, I think someplace, was that, what were we, 22% last year, Louise? In stock performance? For a stock performance last year? For, well, for options, what were your options? Yeah, Louise was up 25%. She had like 100 winning trades in a row or something. And our stock portfolio was about, I think, 23% last year. So way outperformed the marketplace. Does TradeStation provide an indicator which is commensurate to your COT indicator? Yeah, they have COT data in TradeStation, Paul. Do you use your VIX indicator? I do use it, but not often. But yeah, I still look at that stuff. The problem is there's so much stuff. I looked at all the things I've created in TradeStation the other day. I go, oh my gosh, there's way too much there. And my problem is I'm too creative. I have to pluck the feathers off the duck here and get down to a lot less stuff. I've got some really interesting ideas. Some of you have followed up on those and taken them and opened doors when I didn't see, and that's good. But I have to be careful if I create too much stuff, so I try to narrow it down here. Does Louise have option trade? No, Louise doesn't do an option trading course. She's an option writer, by the way. Time to figure out how do you figure out the time frame for market? Well, first of all, Gail, it's about what time frame do you want to trade. And then, like I said, this is IBM, right? So the commercials are buyers here, they're buyers here, they're buyers over here. I probably want to be a buyer. We got a condition, and here's the seasonal pattern. IBM is very seasonal. I wrote about the seasonal pattern IBM somewhere in the 1970s. 1970s. That IBM usually rallies around the 19th trading day of October. So that's about here. Rallies. 19th trading day of October, about here. Rallies. About here. Rallies. October, about here. Rallies, right? It's been a really strong seasonal pattern. So that's a condition to have in the marketplace, isn't it? And then wait until the commercials, etc., are buying. Okay, so if I want to find out the time frame of this market, I'm simply going to count from this low to this low. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 20 weeks from here to here. And I go back this low. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 27 weeks. And about from this low to this low looks about like 27. This low to this low, maybe 30. Now you just get an average of those. That's how you can do it by hand, or you could go buy some of the expensive cycle stuff. Or a lot of it doesn't work. A lot of it is very helpful. The cycle stuff I've used, the timing solutions, is the best one. What course would you recommend for someone looking to trade SPY and large caps on an end-of-day basis? I don't know. If I do a seminar this year, come to my seminar. Okay, so here's how we can stack. This is sugar. These are commercial sell signals in the market. And I'm looking at the seasonal pattern. So seasonally, we usually go down here. Oh, and I've got lots of red stuff here. The commercials are selling the market. Look at that. That's our surrogate index. Seasonal, we should come down. Commercials start selling. So I'm going to stack I'm going to clarify my trade. So entry should be an afterthought. Everybody's looking for entry, and it's an afterthought. You want to first find a market that's set up for a big move. Here's a great example. Oh my gosh, I forgot about it. I should have shown this in the thing. Some of you bought last September, I think, maybe a little bit before that. We did a special report. So I've got a setup market. I think this market is going to decline. It was Treasury bonds. And Treasury bonds far exceeded my expectation, but they were really set up to go down. I said, this is unusual. I think we sold it for $30. And a lot of you got that report. And anything would have worked. Any entry technique would have worked because it was so set up. So don't put the horse in front of the cart, or the cart in front of the horse, rather. It's the driving conditions that matter the most. You could have thrown a dart at Treasury bonds to sell short. You could have used Fibonacci. You could have used the moon. You could have used astrology. You could have used anything for that decline. So the entries are an afterthought. It's all about finding these markets that are really set up to have a massive, major trend directional move. That's what matters the most. What are your favorite tools in timing solutions? Mark, I'm just limited on the cycle stuff. What's a realistic compound rate of return trading futures? Realistically, if you do 30-40% a year, you're knocking it out of the park. 60% is phenomenal. How many fund managers last year did 10%? Damn few. So you're beating the industry if you can do 30 or 40%, 60%. Most people have their expectations way too high. And of course they fail, and then they get bummed out and they stop trading, or then they try to overtrade. Most people have realistic expectations about a return, because one of the worst things I ever did was win the Robbins World Cup Trading Championship, because people, I can make 1,000% a year too. No, you can't. I was so focused. I worked so hard at it. It was an extraordinary time period in my life. So if you're close to 100% a year, you're phenomenal. Just don't have such a high expectation, and then you won't have to put all these pressures on yourself, because it's the pressures that destroy your relationships with other people in your life, and it's the pressures that will actually destroy your own trading abilities. What's your favorite market to trade? Marshall, my favorite market to trade is the market that's the most set up right now to rally or decline. Does that make sense to you? As opposed to, I'm going to be a gold trader? What an idiot idea that is, right? I will only trade gold when it's set up to rally or decline. Rest of the time, if it's not clear to me, I'm not going to be trading gold. So I don't have a love affair with the market. I have a love affair with the conditions that cause major moves. That's what I do. Dear Mr. Williams, you made 80% last year following your basic course. Well, Martin, congratulations to you, and you did it. It wasn't me, and you did it great. So congratulations to you. Okay, so entries are an afterthought. Now, here's been my weaknesses with entry. I assume my weaknesses are probably your weaknesses. I'm too early. Fools rush in. I've learned that I rush in too soon. Like, oh, I see his market all set up, and I get in too early. So that's been one of my weaknesses. I've learned to sit in my hands and wait a little bit. The market's going to give me an entry. Let the market show me the entry, as opposed to me trying to spot the absolute low. I'm not going to do that anyway. It's not going to happen. So let the market come to me. Let it sing the song, and I'll hear the tune. Because I've been a fool and rushed in so many times in my life. I'm still foolish, but I don't rush in quite as much as I used to, that's for sure. And not willing to reverse. So you get a signal and it falls apart. Reverse. There's a big message there. Because I believe in the trade, I believe in the entry technique too much that I don't take a reversal in the marketplace. So question your beliefs. And this has been a real big problem of mine. I believe this trade is the big one. So I get a profit in the trade, and then I'm stopped out with a small loss or a small gain. And I could have gotten out with a nice profit in the trade because I don't take my profit soon enough. So those have been my weaknesses. I don't know that they're your weaknesses, but you might want to look at that, see if that pertains to you or not at all. How does Ralph Binzer differ from your money management formula? Well, Ralph is more aggressive than I am, but he explains the rules and the laws of money management and the mathematics of it. So it'll give you the background you need to know so you can actually understand this stuff. Any tips to maintain discipline? Yeah, here's how you maintain discipline. Why you're undisciplined as a trader, I think, is because your emotions override your discipline. So we lose discipline because our emotions kick in. Why do our emotions kick in? Because we're betting too much for our emotions. Our risk management is too large for our emotions. If you and I are going to bet a quarter on the Oregon Duck football game later today, I'm going to take the Oregon Ducks, right? Because I went to school there. And if I lose a quarter, fine, no big deal. But if we bet $180,000 in the game, every single point in the game today is going to drive me crazy and you crazy. It's a bet, but and it's the same game, but what drives us crazy is the bet size. So discipline, I think, is a function of your emotions are too big for your bet. Past charts give us some perspective about what might work, but we all need to look forward. What market is currently looking like it might be set up to go long or short? Go to my Larry TV, guys. Subscribe, $25 a month. Go there. I got all that's there. I just did it this morning. I don't recall what's set up right now. The dollar index is going to go down. There's an example of one. Okay. We're going to have a major stock market decline later on this year. There's an example of one. Maybe July 19th. I don't forget the exact date. But, if you're really interested in the markets, get Larry TV. Are Mondays usually cycle down days for the E-minis? They tend to be. What other conditions to rally or decline in addition to COT? Well, other conditions in the marketplace would be commitment of traders, cycles, seasonals, by pinch and punch formation, accumulation in the marketplace, advisory sentiment. There's 6 things right there for you. Ark wants to know, how big of a decline do I think is going to happen? I don't know. I'm pretty good at saying we're going to have a decline. The magnitude, I'm not that good at that, to be honest with you. But, a 10-15% correction in the marketplace. I'm more concerned about time. How long will that decline last? It could last 6 months. China, I post a lot of stuff in China, the CNN there, so Chinese News Network. So look at it there. Probably the best way to follow it. I have Ninja Trader. Where can I get them? I'll let Louise answer that. Ninja Trader. There's been a couple people wanting to know about Ninja Trader, Louise. Is a full moon a buy signal? Oh, it's not that simple. What is the difference between cycles and seasonality? Oh, that's a good question. Seasonality happens because things are planted, they're harvested at time periods of the year. Banks are refinance stuff at certain times of the year. Coca-Cola sells more Coke in the summer than the winter. So that's seasonality. Cycles are, I don't know what really causes cycles. I don't know what anybody does, but they're more ephemeral, and they're not, from what I can tell, necessarily based on a condition. I really don't have the answer for that. I apologize. When you're deciding on the length of cycle, how long is your look back period? I'm going to look back a couple years because I'm trading longer cycles. I'm not trading a 5-day cycle. If I was trading a very short-term trader, then I'd probably look at like the last year. Flavian, what was your question here? I saw your name come up. Years ending in 7, years ending in 7 tend to decline. That's one reason why I think we could have a significant decline this year. Is your current market lagging your 2017 forecast? No, Doug, look at the 2017 forecast. Says we're in an up move, and it should continue going higher until, well, you got the forecast. So we're still in a primary bull market. That's my view. What condition likely caused a July correction? I don't know. I don't know. I don't care, really. I don't know if it's July. Just bounced that off the top of my head. But somewhere later this year, I think we'll have a big correction. But when we get there, guess what? The commercials will be selling. We'll see the advanced decline line fall apart. We'll see bonds outperform stocks. A lot of stuff will start to happen then. So let's wait till we get there. Wave counts? No, I don't believe in Gann and waves and Elliott, all that stuff. Maybe I'm just not smart enough to figure it out. I tried to. I knew W.D. Gann's son. Had dinner and drinks with him repeatedly. For me, that stuff doesn't work. Maybe it works for other people. Doesn't work for me. So, look at that. Thank you, all you people from all you different countries. That's all, folks. I will sit here for a little bit more to see if any other questions have come in. Thank you, Flavin. Yeah, I'm getting better daily here, but boy, it's slow, especially the stupid tooth thing. In your research, have you compared breakout entries versus reversal point entries, especially in strong trending markets? Again, Amir, entries are the catapult to a move. They're not significant. They're not as significant as finding a market that's set up to have a big move. So it's all about the condition. Then they're all going to work as good or as bad. So the entry techniques are the tail of the dog. You better find out what direction the dog is going in. That's more important than seeing, oh, the tail is wagging this way. That's not significant. The significant is the underlying conditions of the marketplace. And so few people want to focus on that. They want to focus, where do I buy, where do I sell? Well, why do you want to buy it? Because it's an uptrend. Not good enough, because uptrends can change. Okay, learning something. Well, I'm glad you learned something new. Thank you very much. Appreciate that, Joe. The big thing in short-term trading or shorter-term trading, if you just buy something and hold forever, you're going to get a 9% rate of return. By trading, like one of the students said, he did 8% last year because we did it out in the marketplace. A short-term trader potentially can make a lot more money than somebody just buying and holding. Does your running and training for it help you mentally? Yeah, I think running, I still try to stay in shape. I think it clears my mind because I just see charts all the time, and and I'm in a little pain from running or whatever. I get my mind out of it, and occasionally I get freedom to see some thoughts about the markets that I don't just see just looking at the screen day in and day out. Well, thank you, SS, for that comment, but I'm only a legend in my mind, no other place. Audio glitch when we talk about accumulation. I use an indicator called POVI. I wrote about that. It's an open indicator in Futures Magazine, I think. And it's a combination of price, open interest, and volume all in one indicator. Pretty good measure of accumulation. Hey, Martin, I'd like to come back to Prague. One of the most interesting books I read this year is about Zatopek, Emil Zatopek, the great Czechoslovakian runner. What a story, what a life he had. What do you mean by a big loss in your MM formula? Is it one single trade? Or one. I'm worried about one large losing trade. That's one of the big lessons from Ralph Vince. I don't really care much about drawdown as much as can one trade wipe me out. Gregory, yeah, that's an idea, kind of like Bollinger's contraction of his band. But why the turtle thing works is because there are a lot of markets and one has a big move. if they would just think about finding markets that are conditional and ready for rallies, they could make the turtle system a whole lot better. To me, it's all about conditions in the marketplace. Oh, so Amir, what's confused you about accumulation? What's the cost of the trend trading course? It's way too expensive. It's on our website, but you probably don't want it. Can you comment about your indicators on Vantage Point software? Yeah, Orlando, we have Vantage Point is another one of the softwares we partner with. They have a lot of my indicators there, and they're all for a separate purpose. One for accumulation, one for professionals. So each one serves a separate purpose there. What is your near-term seasonal outlook for gold and silver? Well, gold higher, U.S. dollar lower. We talked about that earlier. Yes, Wefwe, I guess your name is. You'll get a notice when this is posted, and you can re-listen to this. How do Kotze and POVI relate to each other? They're totally different. POVI measures accumulation in the market. Our surrogate index says if there were commercials in a market, when would they be buying and selling? So they're quite different. I watch Larry TV. Don't commercial traders do more hedging compared to speculators? Yes, Amir, they do more hedging, and that's why we can't just automatically say, oh, the commercials are selling, let's sell short. We still have to look at that at another level, which we do on Larry TV, as you know. Do you use different bar lengths for long or short trailing stops? No, I'm much more concerned about how many days last 3 or 4 or 5 days. Larry talks about trailing stops. If I had a profit since first trade, yeah, if you're in a profitable trade and the market's moving, well, I'm going to rattle here. You get into trade and it's going back and forth and back and forth. Your stop needs to be several days away, lowest of the last 10 days, whatever, quite a ways away. Once the market breaks out and starts to move, then you can bring your stop up to the lowest low of the last 1 day, 2 days, whatever you feel like. But initially, your stop needs to be a ways away until you break out in your direction, anticipated direction. Then and only then do you raise your stop up. Can moving average crosses be a good indicator of trend direction? No, they don't work. Only if you put them on top of a condition. But there is no moving average system by this one crosses that one. Remember, that's the Merrill Lynch study. They didn't work. They didn't hold up. They never held up. So don't spend too much time on that. Don't see the picture perfect course on your I really trade website. Oh yeah, and we haven't gone to Larry. Louise still has to post Larry TV today. This is a big weekend of work for us, so don't go look at Larry TV right now, guys, because it won't be there yet. Now she's done this all morning with me, and now she has to spend probably 8 hours getting Larry TV ready. Do you invest in stocks for? He wants to know how to get the trend trading course, Louise. Do you invest in stocks for long term? Yes, I do. Not for years, but we roll our portfolio every 3 months. And you can see that in our stock course on ireallytrade.com. And we do it with our own money, with over $1 million to do it. So we really do this stuff. Currency pairs way over my head. I don't know anything about currency pairs. Exit techniques, well, maybe we'll do a webinar on exit techniques. To period by the day after percent hours oversold or over trading. No absolute answer to that. Lee Geddes, any thoughts on his method? Well, gosh, I've known Lee for a long time. I had nothing but great respect for Lee. I don't know what he's doing right now, but he's been a wonderful supporter and friend for many years, and I think he's a real professional in the business. Is Picture Perfect course only for people who've taken the trend trading course? Louise will answer that. Larry, new book coming out? No, I have arthritis, my fingers, and I never did type. I never learned to type, so now I'm using Word Dragon to dictate, and I just don't have the angst or the ambition that I did when I was younger. I really don't feel like writing a book. Things change as you get older. I mean, some of you are young, and look at your parents. I'll be 75 this year. Your parents running around writing books? I'll bet not. It's just kind of a natural cycle of Larry Williams, and I think what happens to people. Do you consider markets as action metaphors or more? Well, Charles, I think markets move from $10 a share to $60 a share because of fundamental conditions. But the wild gyrations in between are caused by psychological and emotional events. So The overall trend is fundamentally driven, but the swings, the craziness back and forth, that's the news, the emotions, the traders having margin calls, all that stuff. So there's two things going on, and then the driving force. Any art of short-term trading this year? We'll see. I don't know. A lot of things planned this year in our personal life, so I don't know what we're going to do. We haven't done a seminar for how many years, Louise? Since 2014. So we've done a few of these webinars, but this intense, heavy teaching stuff, I don't know. Anyway, it's time to wrap this up. I'd like to wish all of you good luck and good trading, of course. Thank you very much for being here today. I hope it provided a little insight to you how to look at entries, how to use entries and different entry techniques you can use when the conditions are correct. Until next time, good luck to you and good trading.